Thank you for joining us today for a presentation and discussion on how ITEP's distributional data can be part of an advocacy, communications, and grassroots strategy to secure and advance equitable and sustainable tax policies. ITEP is a nonpartisan tax policy organization. We conduct rigorous analyses of tax and economic proposals and provide data-driven recommendations on how to shape equitable and sustainable tax systems. ITEP's expertise and data uniquely enhance federal, state, and local policy debates by revealing how taxes affect both public revenues and people of various levels of income and wealth. ITEP's Aidan Davis will kick off the webinar with a brief overview of findings from the 6th edition of Who Pays, a distributional analysis of the tax systems in all 50 states. Dylan Grudman will then offer a broad set of policy recommendations that help to build toward more equitable and adequate tax systems. They'll then be followed by two of our state partners, Misha Werschall and Ted Butner, who will share their experiences of putting ITEP's data to work and their fights for more progressive and adequate revenues in their states. After the presentations, we'll have 30 minutes for questions. If you'd like to put your name in the queue for questions, send them to me via the chat function in Zoom. We'll try to get to all of the questions, but if we're not able to get to your question or if it's super state specific, I will be sure to follow up with you directly via email by the end of the week with a response. Lastly, the speakers are going to be referencing a lot of data, analyses, and reports in today's webinar. Don't worry, we're going to include a resources list on our website at itep.org, as well as in a follow-up email along with a link to the recording of today's webinar. And now I'll turn it over to Aidan Davis.
Hi, everyone. Thanks again for joining us this afternoon. So our plan today is to talk to you about ITEP's study, Who Pays, and our work more broadly, and also to provide information on how that analysis can be put into action. So to sum it up, how states tax their residents matters. Taxes provide revenue for a host of investments, including education, public health, public safety, and transportation infrastructure. ITEP works to ensure governments at all levels have sufficient revenue to meet those common needs, and that revenue is raised in a sustainable and equitable way. We produce Who Pays every few years to assess how states are performing on this basic question of tax fairness. Here's what our latest analysis tells us. On average, the nation's lowest income 20% of households pay an effective state and local tax rate that is 50% higher than the rate paid by the top 1%. If you look at the slope of this graph, you'll see that state and local tax systems collectively are upside down. The more income you have, the less you pay in state and local taxes as a share of your income. And these upside down tax systems are not only inequitable, they fall harder on communities of color and continue to drive immense racial disparities. Income inequality has been widening for the past 4 decades. While state tax systems have not caused this problem, they certainly contribute by capturing a greater share of income from their lowest income residents than from higher income taxpayers. So as a result, the tax structures in 45 states make income between high and low income households less equal after taxes, furthering this income inequality divide. However, this report also shows that some states are doing better than others on this tax equity test. In 5 states and the District of Columbia, the state tax system makes a very small dent in income inequality, largely by asking their wealthiest residents to pay a higher share of income in taxes than their poorest residents. And while state tax codes are not a cure-all for economic inequality, well-designed tax systems can help lessen this problem, while steeply regressive tax systems only make it worse. And the primary reason that most state tax systems are upside down is that they rely more heavily on consumption taxes, meaning sales and excise taxes, and less on graduated personal income taxes. At the state and local levels, most families actually pay more tax on what they buy through sales and excise than on what they earn through income taxes. You can see this discrepancy play out dramatically in states that have the most regressive tax systems in the nation. If you look at the 10 states that our study revealed as having the most regressive tax systems, 7 of them do not levy a personal income tax at all. Of the 3 that do levy income taxes, the income tax is either flat or nearly flat. So in other words, lower middle income families face the same marginal tax rate as the highest income taxpayers. And so the tax offers a poor counterbalance to regressive sales and excise taxes. And then these states also tend to rely heavily on taxing what people buy in order to afford their governments. 6 of the 10 most regressive states derive half or more of their revenue from sales and excise taxes. So in other words, they're leaning heavily on taxes that fall disproportionately on lower income households. The mix of taxes used to fund state and local government is hugely important in determining the impact felt by people at various income levels. It's a common misconception that states without income taxes are universally low tax. Texas is commonly pointed to as a low tax state, but the reality is that low income people living in Texas pay much higher taxes than they would if they lived in so-called higher tax states like California or New York. The bottom line is that the vast majority of state tax systems are regressive, but tax regressivity isn't inevitable, and states have options to remedy this problem. In a recent ITEP report, Moving Toward More Equitable State Tax Systems, we touched on a range of approaches that would do just this. So now I'm going to turn it over to my colleague, Dylan Grunman, who will walk you through that research and propose some tax policy options for advancing equity and addressing this income inequality and these racial disparities. Take it away, Dylan.
Thank you, Aiden, and good afternoon, everyone. So my name is Dylan Grunman. I'm a state policy analyst at ITEP, and the Who Pays data that Aiden summarized for us, we feel really lay out a foundational baseline that can be useful for educating policymakers and the public about the upside down nature of state tax systems, and also as a baseline from which to advocate on to improve on this picture. So we feel that armed with that sort of data and the data that we can provide in our analyses of specific policies and proposals and some good advice, advocates and policymakers will be well prepared to advance economic and racial equity through their state tax systems. So this new report, Moving Toward More Equitable State Tax Systems, is meant to be the good advice piece of that puzzle. So our first category of recommendations is to emphasize revenue sources that reflect underlying inequalities. And what we mean by that is that, as Aiden pointed out, income is extremely unequally distributed. So states that tax income and corporate profits have a bit of an easier time funding important public services without making that inequality worse and to some extent mitigating those inequalities. But there are 2 big caveats to that. First of all, you do not have to have an income tax to make progress on the upside down nature of your tax code. There are a number of options in our report and that I'll mention in this presentation, and some outside the box ideas that states without income taxes can follow. One example of that actually is in Washington State. They're looking at applying an excise tax to capital sales. And there are many more options like that. And then the second caveat is that just having an income tax is not enough. The details really matter. So again, as Aiden mentioned, 3 of our terrible 10 most regressive states do have income taxes, but they're just very flawed. They're either flat or effectively flat, or they have deductions and exclusions for the highest income households that are extremely generous. And the states are therefore losing out on the progressive potential of their income tax. Furthermore, even of the states with personal income taxes, the majority have top marginal rates that kick in at less than $36,000 of taxable income. And that's despite the fact that the real economic income growth that that Aidan summarized is in that top 5%, top 1%, top fraction of 1%, people with hundreds or millions of dollars of annual income. So in our report, we lay out some options for states to either widen out their existing income tax brackets or add new brackets at the top, and raise those rates at the top to make sure that you're applying those highest rates to the truly high income families who are really benefiting the most from today's economy and driving that inequality picture. A little bit of lower hanging fruit within income taxes would be adjusting your tax brackets for inflation and other provisions in your tax code so that they don't fall behind over time. Within the report, we also cover some best practices states can implement to apply progressive taxes to corporate profits and inherited fortunes. The second big category of recommendations is don't overuse consumption taxes. So as Aidan mentioned, heavy use of consumption taxes is a key feature of many of the most regressive state tax systems, and the more equitable states generally rely on them less. So the first piece of policy advice is just to lean on those revenue sources sparingly, and when possible, shift to more progressive taxes. Other steps include exempting groceries, which most but not all states do, and offering refundable credits to offset the severely regressive nature of these consumption taxes. So following on that, our third recommendation is to make use of targeted refundable tax credits. Tax credits done well can really help promote equity in several ways at once. They can be targeted to low and middle income families who are also disproportionately people of color and who are also those same families most affected by those regressive consumption taxes we just talked about. So there are a number of ways to design these and make sure they're targeted to the people who need them most. The earned income tax credit is the most famous example. It's a federal credit that's targeted to low and middle income working families, and states can piggyback on that in an administratively easy way. There are also child tax credits, property tax credits such as circuit breakers and renters credits. But again, the details here really matter. Refundability is absolutely key to offsetting those regressive consumption taxes and making sure you're delivering meaningful benefit to the lower income families. And also even the federal EITC is not a perfect policy, so states are looking at ways of enhancing and expanding that credit and other credits to provide as much equitable bang for the buck as possible. And again, these are typically administered as income tax credits, but you do not have to have an income tax to have credits like this. Our fourth area of recommendations is to trim unnecessary and ineffective special tax treatment. So basically, not all special provisions of the tax code are as helpful and wonderful as the earned income tax credit is. A lot of them are enacted with good intentions and are very popular, such as itemized deductions for mortgage interest or charitable contributions, but they actually have a regressive effect on tax codes because only the higher income people are generally able to itemize and take advantage of those deductions. So we offer a number of ways that states can reform or even repeal itemized deductions. Standard deductions and personal exemptions are another area that are very common in state tax codes and available to everybody, but they don't have to be available to those highest income families. So there are different ways that states can target those provisions better and phase down the benefit for the very highest income people. And then there are also special tax treatments that are just primarily available to wealthy households and are really unnecessary, such as tax breaks for capital gains income and pass-through income that states can look at paring way back on or even eliminating and improve their tax codes in that way. And then our final piece of advice is to pursue bold reforms to remedy long-running distributional inequities. And what we mean by this is that even the states that are following a lot of our advice here are still, at best, not making economic and racial inequality worse with their tax codes. There's no state in who pays with a truly progressive tax system. So we encourage states to, for one, identify the progressive features of their tax codes and amplify them, which you can do by raising top income tax rates, targeting those top rates even more to those highest income families, increasing or enhancing those refundable credits we talked about. You can also shift even further away from regressive consumption taxes. We encourage states to look at taxing wealth and the fruits of wealth. And finally, to give local jurisdictions more progressive options. Our cities, counties, and schools generally only have options to raise revenue through regressive consumption taxes, or excuse me, regressive sales taxes, mildly regressive property taxes, and very regressive fees. So states have the power to grant more progressive options to those local jurisdictions and improve on the local piece of this picture as well. So with that, I will hand it back over to Meg.
Thank you, Dylan. So as you all heard from Aidan, essentially every state has an upside down tax code, but that stark reality is especially true in Washington state. We are delighted to have Misha Warshkal, the ED of the Washington State Budget and Policy Center, here with us today to share some examples of using ITEP's Who Pays data to build a case for a more equitable and sensible tax structure in her state.
Great, thank you. This is Misha from out here in Seattle on the webinar to share a little bit about work that we've been doing and to make you all feel better about your state and local tax codes. I wanted to start off just by mentioning that, you know, for us here in Washington State, and there may be other Washington State folks on the webinar, we know that this ITEP Who Pays data is really foundational for all the work that we do in Washington, and is really critical to our future success reforming Washington State's tax code. So I wanted to start just by complimenting the team at ITEP and thanking you all for this work, the Who Pays data, as well as all of the other research that you do. So I'm going to talk about a public education campaign that we've been working on that really is based on some of the data from the Who Pays report. So first, just to kind of orient you to Washington State, we have the worst in the nation tax code. You can see on your screen in the ITEP report, and this has been actually long-standing for Washington State. We've had the most upside-down tax code in the country, with low-income working people paying up to 6 times more a share of their income in state and local taxes as the wealthiest 1%. So we have a lot of work to do here, and I will just mention at the outset that, you know, this chart here is in pretty much every single presentation you'll ever see from the staff at the Budget and Policy Center and our partners, because it is so important for framing what the challenge is in Washington State. Our goal is to raise revenue in the state in a progressive way and make sure that it's adequate to meet community needs, and also address the underlying racial disparities that exist in our state and local tax code. And so the public education campaign that I want to talk about is really rooted in a couple of years ago, after really failing to make progress reforming Washington State's tax code. a group of stakeholders got together to really look at, take a step back and look what was going on in terms of how people are thinking about taxes, how people are thinking about government, and really trying to start a little bit fresh about how do we engage the public in these issues. And what we found as we did messaging research with Topos and other partners is that, you know, for the most part, voters in Washington state are engaged in a very negative frame around taxes. They feel like they're paying too much in taxes. They feel like it's a hodgepodge of different taxes coming at them every which way. And when they hear a conversation about changes in the tax code, it very quickly slots into their existing framework that has been, you know, built over the years of kind of taxes that are too high, another tax that I'm going to have to pay, and that it kind of goes into the black hole of state government. And what we found is that when we, as I mentioned, as we talk about, you know, changes to the tax code and people very quickly revert into that way of thinking, as you can imagine, that's not a very positive frame for us to be operating within. We found that, and this is where I come to the ITEP data, what we found is that when we actually zero in on one of the key facts from the ITEP Who Pays report, that we can actually create a different conversation with voters and with the public in Washington. And the key fact that I already mentioned is that working people, low-income people in Washington state pay up to 6 times more a share of their income in state and local taxes than the wealthiest. And why this is really effective is a couple of reasons. First of all, you know, I think it's a relatively easy thing for people to understand about a complicated system that is not transparent to most people, our state and local tax code. It also gives people context for what they're experiencing. So most people in Washington state do experience that their taxes are too high. And coming back and telling people that their taxes are not too high is understandably not effective because it doesn't match with the reality that most people are experiencing, that they're paying significantly more than their fair share in taxes. And then finally, this fact is powerful because it's surprising. You know, out here in Washington, we believe we're the best at everything. As you know, this is true in a lot of states, but we have a lot of Washington state pride. We believe we're leading the nation in all kinds of areas. And when we hear that we're actually worst in the nation when it comes to our tax code, and that our tax code is significantly driving income inequality in our communities, and that working people in Washington state pay double what they would in most other states, that is really doesn't fit with people's context that they already have about our state. And that element of kind of surprise or disconnect with our own experience is actually helpful for opening up a new conversation with voters. And so through this research, what we found, again, is that this fact is really powerful, it's understandable, and that it helped break out of that old frame of thinking, and at least for a moment, enter into a new frame. And we found that voters have a much more openness to talking about solutions after really hearing this larger systemic issue that low-income people are paying 6 times more than the wealthiest. So I wanted to just quickly give a couple of examples of how we've used this data in kind of our public communication. So first, when the Who Pays report was released last year, we launched a social media campaign with partners to try to get this kind of key fact out there. So if you can go to the next slide, this is one of the graphics that we used. Washington state is #1 in terrible tax codes, playing off that, you know, Washington pride and then revealing the surprising fact. A second that we use specifically with our work around the Working Families Tax Credit, our state campaign for a state EITC, is kind of, again, playing off this pride in Washington, are, you know, so proud of the apples that we produce, but we also have this dirty little secret of our terrible tax code. So then, as a supplement to this, through a partnership with a number of organizations, we've launched a campaign called the Balance Our Tax Code campaign that's really much more ambitious in terms of the number of people that we're trying to reach. So I can answer more about this in questions if people have Q&A, if people have questions. But really, we had a universe of about 700,000 voters in Washington state that we knew needed this kind of grounding in a different way of thinking about taxes. And so we worked with a digital strategy firm to develop kind of a campaign-like series of ads to get this message out there. I'm just going to show you one of them really quickly. This is the turtle ad, and it's just 15 seconds, so you can go ahead and play it.
Being upside down is awful. We should know because Washington has the most upside down tax code in the country. Working people pay 18% or more of their income in taxes, while the richest pay 3% or less. Let's flip it around. A balanced tax code helps us move forward.
So we've been, showing that through digital media, Facebook, Instagram, Twitter, and so far have 1.8 million impressions on it and nearly 700,000 complete views of it. And we've learned that, with this ad in particular, it's really, as we've tested it, been very effective at reaching some of those target audiences. And again, I can answer more questions about that for the sake of time. I'll stop there. And we'll see what this means for Washington State and our ability to move progressive tax reform forward in the current legislative session.
Great, thank you so much, Misha. Misha's story really helps to elevate strategies for effectively using ITEP's Who Pays data in your states. But as many of you know, ITEP staff works tirelessly during legislative sessions to help you all make sense out of how proposed tax changes, both big and small, will impact equity and revenue levels. So Ted Putner, the ED of the West Virginia Center on Budget and Policy, is going to share with you all a story of how his organization effectively used ITEP's quick turnaround analyses to prevent a disastrous policy change in his state.
Great. Everybody hear me okay? Thank you. Well, first of all, it's great to be part of this conversation and to highlight one state that has been able to use ITEP data tax policy analysis to stop what would have been, without a doubt, an economic and fiscal disaster in West Virginia. This story starts out with our newly elected governor, Jim Justice, who is the state's only billionaire. Shortly after taking office in 2017, our governor joined with GOP leadership, especially our state Senate, to push for the elimination of our state's income tax. This was just after our good friend Art Laffer visited to tell them about his magic math. And over the course of the regular session in 2017 and 3 special sessions, there was a total of, count them, 12 tax proposals that passed out of at least one committee or chamber, most of which eliminated the income tax and replaced part of it with a huge expansion of the sales tax. And this is where analysis from ITEP comes in to save the day here in West Virginia. Over the course of about 6 months, we worked with ITEP to model the impact of each proposal and the impact that they would have on everyday West Virginians. As you can see in this first chart, you'll see a chart and you'll also see a news article about how contentious the income tax reduction deal was in our state legislature. But this first chart can show you our first analysis that we had ITEP look at was rather unique. The bill would eliminate the income tax and sales tax and replace it with a broad consumption tax. As you can see in that chart, it would provide the top 1% with a tax cut nearly $28,000, while forcing the bottom 80% of households in our state to pay for that tax cut by making up the revenue with an increase in the sales tax. Altogether, this bill would have lowered tax collections by about $1 billion while making low and middle income people pay for the tax cuts. This data and chart played a crucial role in getting most legislators to oppose the plan, especially in the GOP-controlled House of Delegates, many of which saw huge sales tax rates as something that would hurt local businesses that are on the border of the state of West Virginia. Over the next several months, there were several other tax plans put forth, and every time one was taken up, ITEP was there to help us run the numbers, and we would produce these charts, and the legislature would keep backing off of the proposals. Here's a couple more. By June, about 5 months into our third special session, legislators would start asking for these charts by name, and as we got closer to June, you can see that the severity of the proposals diminished over time. So at the very first time that we had ITEP run these numbers, instead of $28,000 for tax cuts for the rich, like the first proposal, we were down to just about $1,200 for the top 1%. You can see the remarkable decrease in regressivity, but the tax cuts were still pretty bad. And after all was said and done, we were able to stop each of these tax proposals. In fact, legislators in our House of Delegates especially would ask for these charts by name. And every time a proposal came up, they were like, oh, here come those charts with the arrows and the different colors. But they played just a crucial role in stopping all of these tax cut proposals. Here's one senator. His name is Senator Ed Gaunch from Kanawha County, where I live here in Charleston, West Virginia. He was one of the leading advocates for eliminating the income tax. As you can read in the quote there, he was quite frustrated by the charts. He didn't believe that, that these were tax rates for the rich. And he admitted defeat the following year. In January of 2017, he admitted that this was a waste of time and that they were not going to take up this issue this year. In fact, after this year, he was replaced by the most progressive state senator in the state when he lost his election bid in November of this year. So what I'm trying to say in the story is that throughout this whole 6-month period, ITEP was there, and I think it's safe to say that the legislator would have drastically cut the income tax without the advocacy on the ground and without the data. They knew every time that this proposal was going to come out that we would create one of these charts and let especially people on social media and people in the newspapers, they all quoted these charts every time a proposal came out. They knew that this was going to be something that they could live with and go back home to their citizens with to talk about. So this is just one example of how using this data and being very persistent the whole time, you can stop a legislature that most of which is bent on passing something. And just to give you an idea, we have a Republican-controlled legislature in our House and our Senate, and our governor actually switched parties after this tax debacle, blaming the Democrats for not going along for his income tax. So it had huge political ramifications, and it would not have happened without the data from ITEP.
Thanks, Ted. Well, and thanks actually to all of our presenters, and thanks again to everyone for joining us today. I'm going to open it up to questions. I already have a number of questions that have come through the chat box. I'm going to start with those and do my best to manage new questions as they come in. Don't hesitate to continue sending questions my way. The first question I'll give to Dylan, and that is there any historical proof that these proposed tax policies will create equity, or are they just theories?
Thank you. That's a great question. I think the data that we put out in Who Pays, and specifically the inequality index by which we measure the relative extent to which state tax codes are exacerbating inequality, that's definitely not theory. That's data showing that state tax systems are making before tax inequality even higher after tax, and that some policies in some states are doing a better job than others. And then, and as a more specific example, I think New Jersey and Texas are a good contrast, and we're actually coming out with some work on this, including a video that'll be up on YouTube to keep an eye out for, because New Jersey and Texas actually start out with very similar pictures of inequality before taxes, but their tax codes, but they end up in very different places after taxes. So so again, that's not theory. That's real data showing that the tax systems are making a difference.
Great, thanks, Dylan. Aiden, is there any state that has a model personal income tax structure where the brackets apply at appropriate levels of income and the rates step to have the desired level of progressivity?
That's a good question, because I think that's what everyone's striving for. So there are a lot of states that have income taxes that are nominally graduated, but when you look at the details, the brackets are either far too close together or the tax rates just don't rise very much with income. And sometimes this is because the brackets were written into law decades ago and were never indexed to inflation. But there are also a lot of states with genuinely progressive income taxes. So California comes to mind, where low income families are typically exempted from the tax, and high income families can face marginal tax rates that are as high as 13%. And Hawaii also comes to mind because their tax rates range as high as 11%. But that comes with a big asterisk in Hawaii, because the state also offers a big tax break for investors with capital gains income. So I think Hawaii is a good reminder that you can't just look at the brackets when you're determining which states have progressive tax codes. You also need to be sure that you're not offering giveaways to investors or businesses that can potentially erode the income tax base and negate a lot of the benefit of a progressive rate structure. But then aside from California and Hawaii, Minnesota, Maryland, New Jersey, New York, those are a few more states that I think are notable and worth mentioning. So it's not just California by any means. There are states in most regions of the country that you can look to as models.
Great, thanks, Aiden. I have a question that's for both Misha and Ted. So maybe Misha, if you want to take it first, followed by Ted. The question starts with a statement: we all love tax policy. I think that's probably true, everyone on the webinar. But I find that legislators in my state seem less enthusiastic about numbers and actual data. What are your best practices in making ITEP data more digestible for legislators who are unwilling to really dig into the numbers?
That's a great question. So this is Misha. I think that, for what my recommendation is really, instead of trying to have folks digest a comprehensive picture per se, like the entire Who Pays report or even the entire picture of your state, is really try to find those kind of key facts that are easy to understand for legislators and for partners, and then use those facts to tell a larger story. So for us, I mentioned the fact that working people pay 6 times more a share of their income than the wealthiest. That, is a compelling place for people to want to engage, whether it's a legislator and how that interacts with their goals as a legislator, or if it's a member of a partner organization, an immigrant rights activist, a labor leader. That's something that people across the board, I think, can really wrap their mind around and want to do something about. So, I think, similarly, sort of the ranking piece of the Who Pays report, the fact that we're ranked, and this obviously is unique to Washington, but that we're ranked, most terrible tax code in the country, and kind of wherever your state ranks, that can also be kind of something that people will want to organize around in a different way than the more detailed data. So I would say, like, very rarely, honestly, do we, and only with very specific legislators and kind of policy experts, get into like the specific details and all the different ways that make Washington State's tax code progressive, because that's just kind of an overwhelming amount of information. But instead, kind of focusing on these key facts. And then, I think, like, I use the comparison of Washington to Oregon a lot because it feels really relevant to folks. And it's like, if you're living across the border in Oregon and you're, working a minimum wage job, you're paying, essentially half as much in state and local taxes than you would in Washington State. And that kind of puts a human face on it. you know, also like looking at the actual amount that people would be paying if they live in another state compared to Washington, because it's less about kind of percentages and big numbers, and it's more about people's actual lives, and what, you know, a couple $100 might mean to somebody if they had that back in their pocket.
Great, thanks. Ted, do you have any other thoughts to add?
Yeah, I mean, I think what's been helpful to us, I think sometimes finding a villain can be helpful too. So if you have somebody very unpopular in your state, saying who's going to get the biggest tax cut of all, you know, will be like Don Blankenship or somebody in West Virginia. I'd say also too, making graphics too based on, so for this was going to be a massive increase in our sales tax, and it was going to bring back our food tax. So telling people like, hey, this is how much you're going to have to pay an additional sales tax on your food, on TVs, anything that you can go through like the consumption data with, and to look at and to plan and to tell a story about like how much more you're going to have to pay on all these items that you purchase because we're cutting the income tax. We have to raise the sales tax, and people, I think, put that together because food consumption tends to be pretty, you know, a little higher for higher income people, but, you know, everybody has to purchase that. So people really understood that when you got down to the nitty gritty of what that actually means for somebody when they go out and buy things.
Great, thanks, Ted. I will take the next question. Actually, I think probably makes the most sense for me to answer. Someone wants to know, how should we account for the difference in states' proportion of upper income and the rich? So for example, Mississippi has far fewer rich people than New York and California. And so my answer to that, and I think it's probably easier to visually see this looking at the Who Pays report. You can access the report at whopays.org. We actually target, Who Pays the distributional data is very state specific. So the top 1% in Mississippi is the top 1% for Mississippi. And clearly many of those taxpayers aren't anywhere close to the wealth and income of taxpayers in New York and California. But to put it more simply, in each state, we're setting the goalpost for the income distribution and including the breakdown of the top 20% based off that income in that state. And so I would say that just because there are many less millionaires in Mississippi, it's still a problem to have a tax structure in the state of Mississippi that relies more heavily on those families and households at the bottom of the distribution than at the top, just, you know, relevant to what you're looking at in that state. The next question is for Aiden. The question is, in public debates about progressive taxes, we consistently hear the response that progressive tax rates will cause large businesses, corporations, and the wealthy to leave for other states with better tax rates. Is there any evidence to suggest that this is true?
Yeah, so there are definitely a lot of anecdotes to support this narrative, but the data don't tend to support those stories. And the most authoritative study on this topic was done in 2016 by a team of researchers, both out of Stanford and the IRS. And they had access to this amazing IRS data set that I think a lot of people on this call would get pretty excited about. It had a lot of level of detail that you can't find in publicly available data. And in particular, they had access to data on every tax return that reported at least 1 million in income over a 13-year period. And this is exactly the type of data set you would need to be able to provide a solid answer on these types of questions of elite migration. And they found that this elite group of top earners was actually less likely to move across state lines than the general population in any given year. And with only a very few exceptions, and the researchers found no meaningful linkage between state tax rates and the migration of top earners. So it really comes down to the fact that these high income taxpayers, they've really already found economic success, and they don't really need to uproot their lives in search of a few percentage points worth of savings in state taxes. And in particular in cases where it would mean that they would need to like move away from their family or from long-term business connections. So I think while a lot of people talk about moving because of taxes, this research in particular showed that with beyond any doubt that those movements are exceedingly rare. And in the big picture, it's just not a sensible rationale for states to not tax for states to tax the rich more lightly than they tax everyone else.
Great, thank you, Aiden. And we had someone ask during the, well, as your description of that, for a link to the research that you were describing for Christopher Young's research. So we'll be sure to include that, as well as a couple of other good resources, kind of helping to dispel this myth in the follow-up email we'll send after the webinar. Another question for Dylan. We have someone who's joined us from the state of Illinois, and they want to know, their question is, to make a significant difference in their underlying tax inequalities, they would need to both substantially lower taxes at the bottom and significantly increase them at the top. Are there states that are trying to do more than make marginal changes at the top or bottom? And if so, what policy changes are they advancing?
Thank you. So the states that come to mind immediately are California, New Jersey, and the District of Columbia. In Who Pays, you can see that California and DC are way up there toward the top of the more equitable tax codes, and they get there in slightly different ways. California does a really good job of taxing millionaires and actually setting up their tax brackets in a way that reflects that underlying inequality I was talking about. Whereas DC does a really great job of holding low and middle income people, holding their taxes down and offering really robust refundable credits to offset regressive consumption taxes. And both of those states do a decent job on the other side of the coin as well. But they sort of get there with different emphases. And then New Jersey comes to mind because they did a little bit of both just last year. They raised their already refundable EITC, they raised the percentage, so that helps the lower income working families. And they also created a mega millionaires tax with an additional rate that applies to people with more than $5 million of taxable income. So New Jersey did a little bit on both ends, and those states that combine those two strategies can really go a long way to promoting equity.
Great, thanks, Dylan. So the next question, again, I think it's more appropriate for Misha and Ted to answer, and I'm especially interested in the differences between how you address this in Washington State and West Virginia. So Ted, if you want to take it first, and then to Misha. The question is, when communicating about the need for a more progressive tax system, is it more effective to focus on how a regressive system is unfair to the middle class, or to focus on the potential increased tax revenue or service benefits of a progressive system?
This is Ted. That's a really good question. I think I think the political landscape on that is changing a little bit, where now it's becoming much more popular to talk about tax cuts for the rich just in and of themselves when discussing this stuff. But for West Virginia, I think using those charts and that data has been helped stop a lot of really bad policies, but it can also backfire too, because there can be policies that are popular if your state's an outlier, like West Virginia is when it comes to taxing Social Security benefits. That sounds really good. It sounds, like, oh yeah, I'm not going to tax Social Security. That's really good. But when you run the data, it shows, in West Virginia at least, that most of the benefits will go to higher income people if we do that. That's a good case of the chart not being as compelling for folks because it sounds good. But we don't really get an opportunity to fight for a lot of very progressive taxes here. That's one of the problems that we have. But maintaining those, like the income tax to offset the sales tax, has been something that we've been able to stop. But we also rely heavily on severance taxes that are mostly exported out of state.
Yeah, and I would say for us in Washington, you know, it is kind of both. So I think we really have found it effective to lead with the kind of issues around kind of fairness and equity, and, you know, this fact that low-income people pay 6 times more. But, you know, really have built into that message that, you know, if we clean up the tax code, if we make it more fair, that we will have more resources to invest in the things that make our communities great. And, you know, so I think it's a little bit like flipping the order from what we used to do, and really leading with that kind of fairness and the regressive system. And then, but including the fact that if we do it, you know, it's going to mean more money to invest in our communities. It's going to be more money for schools. And I think that, I will say, is as important for like legislators and advocates as it is for the general public, because, you know, legislators and advocates are really motivated by, you know, how do we have the money to pay for our public schools? How do we have the money to pay for parks and things like that?
Great, thank you. I think just one, maybe time for 2 more questions. And again, if you send a question that we haven't gotten to, we will respond just directly, follow up directly to you via email. This question is for Aiden, and the participant wants to know, is I guess probably kind of puzzled about why the EITC, that's a benefit to low-income taxpayers, doesn't do more to affect the amount of income or tax disparity.
Oh, sorry, was muted. So state EITs can be a huge help in bringing down effective tax rates on low-income families. And if you look just at personal income tax breaks in who pays, you'll see that some of the states with larger EITCs have negative income tax rates at the very low end of their income distributions. And this is critical in helping offset some of the really high sales and gas and property taxes that those families are paying within any given state.
Great, thanks, Aiden. And one last question, I suppose I'll answer, because maybe other people were wondering as well. And this is a question about messaging. So in messaging, is there messaging logic behind using upper income instead of higher income? I think we've talked about that a lot, and you can imagine there are lots of internal conversations about how to label our graphs. But I think our kind of final thought is that both upper or higher are a bit more nebulous. So it's better to say highest or top. And that's in part because upper income could include those who are merely affluent versus those who are more elite. So in written communication, we tend to stay away from upper and higher. But again, sure, that's our messaging logic on that. Well, I want to thank everyone. Well, let me actually first by saying, Ted and Misha, do you have any final words before we wrap up the webinar?
I don't, yeah, just thank you.
All right, well, thank you so much to both you, Misha, as well as Ted and Aiden and Dylan with ITEP for your great presentation and answers to the questions from our participants. I just wanted to let everyone know that we'll follow up with a recording of the webinar later this week and links to resources, including, again, many of the ones that got mentioned on the webinar today at the email you registered with by the end of the week. And when you get that email, feel free to forward it and share this information with your partners as well. And with that, I'd like to thank everyone again for joining us.